So look, my name's Aidan Mills. I'm the president and CEO of Northstar. It's great to come to talk to you today, and I'm going to be talking about our technology, which essentially takes asphalt shingle tiles, diverts them from landfill, and separates them into their three component parts at the back end of our process. As you may tell from my accent, although we're based in Canada, I'm not actually from Canada. I'm originally from Belfast, in Northern Ireland. Worked for BP for over 19 years, about 10 years in the engineering and operations side, and then moved on to the trading side, and for origination, marketing, and trading. Worked in Chicago for a while, and then up to Canada and to Calgary. And settled here after leaving BP. Worked for a while with Husky, also worked for Goldman Sachs, and then more recently MEG, the oil company, before joining Northstar. So lots of experience across operations and engineering and commercial, and hopefully you'll see some of the stuff we've been able to do since I've been here in the last 18 months. Our usual forward-looking statements, but look, the takeaway from this presentation is that this is a technology play which is completely transformational for the industry. And look, you'll hear lots of people that talk about that today and talk about the market they're getting into. We literally believe that we have the only technology that solves a major problem for waste, and actually the whole waste to value stream. We literally epitomize the whole waste to value stream. We have the technology proven. We're just about to scale it up, and this has the potential to roll out right across North America. I'll talk about the numbers in a little bit, but it's sensational in terms of the upside potential for the deployment of this technology. And we have, as we'll talk about the kind of phase one of the plan, but essentially we have out in Vancouver, in Delta, close to Vancouver, we have our pilot facility. Our first scale-up facility is in Calgary, is going to be ready to go and operate by this time next year. And we have two follow-on facilities as part of our phase one plan, one in Toronto and likely the first US plant in the Pacific Northwest. So here's the problem that we're actually trying to solve. So if you look at the figures, a shingle tile is about 50% aggregate, about 25% fiber. Older roofs, the fiber will be paper, newer roofs will be fiberglass, and about 25% asphalt. And so if you look at the problem today, for the 2022 figures, in Canada, about 1.5 million tons of shingles went to landfill. And in the US, almost 15 million tons went to landfill. So if you think of all the shingles coming off the roofs, in the US market, about 1 million tons can be ground up and put back into roads, depending on your jurisdiction. But the landfill figure for North America is approximately 16.5 million tons. And just to kind of put that in kind of an oil and gas perspective, that's over 24 million barrels of oil. So that's how much oil is literally going into landfill every year across North America. And just to put a perspective of the growth potential for Northstar, nobody else has the technology that we have that takes a shingle tile and splits it up into its individual component parts. If you look at that US figure alone, that is 400 Northstar plants. If you look at Canada, it's about 40. So the market size, if we were to solve this problem with Northstar plants, that's how many today it would require. So the American, the Asphalt Roofing Manufacturers Association, which is the collection of all the big industrial roofers, so, IKO, Certainty, Suprema, etc., Owens Corning, they came out with a strategy statement last year that said by 2035, they would divert 50% of all shingles that were going to landfill away from landfill. And by 2050, 100%. So that's like an oil company's carbon neutral statement. That's the asphalt shingle manufacturers. Essentially, that's their equivalent to the carbon neutral statement. It says by 2050, 100% of all shingles diverted away from landfill. And today there are none. There is no technology to be able to deliver that today. And we believe we have the technology to do it. So if you look, this is kind of how our process works, and it's got the revenue model in it as well, but let me describe it from a kind of a high level perspective. So number one, we have asphalt, the shingles that come from roofs in the front end, and we get two types essentially. So we get some of the manufacturers who obviously create manufactured waste as their manufacturing shingles. They can send us our shingles to be reprocessed or split off into the individual component parts. And then of course we have the shingles that come off roofs. In the US in general, most of the shingles that are made now are fiberglass and all, and are not paper. In Canada, there's still a little bit of a history of paper-backed shingles. That's coming down over time, and in 10 years, my assumption is all our plants will be 99% fiberglass processing. So we get tipping fees on the front end. In Calgary, for example, where the first scale-up plant's going, $110 Canadian to bring a ton of shingles to landfill. And we charge a fee, so we get paid for, some percentage off that $110. And generally in our commercial models, we kind of say about 25% off is our starting point. So we persuade the truckers who are going to landfill, instead of going to landfill, to turn right to come or turn left to come to us. And so our siting strategy is to be close to the landfills. The Calgary facility is about 5 kilometers from one of the major landfills and 4 kilometers from another. So absolutely bang smack in the middle that the roofing and waste companies can drop off. So that's a first part of the model. So then the shingle tile is ground up, separated and processed in our facility, and out the back end comes aggregate, fiber, and liquid asphalt. So the aggregate, 50% can go into roads, and it's currently being tested for going back into shingles. Fiber is exactly the same. Into roads and currently being tested about going back into shingles. And obviously the asphalt can go to 3 sectors. It can go to the road sector, it can go to the flat roof sector, and it can go to the shingle sector. And so if you can imagine, as we think about the ESG pressure that some of the shingle manufacturers are under and the road manufacturers are under, and we offer the ability to provide the lowest carbon asphalt and fiber and aggregate as a completely circular economy, that's a huge potential for the company. And of course, now we have aggregate and fiber sales, we have asphalt sales, and as you look at the business model, and if you zero carbon credits out, tipping fees are probably about 30 to 35% of the revenue stream. Asphalt's about 60, and fiber and aggregate's about 5. So you can see the relative value is obviously that the highest value comes from the asphalt. This is an ESG story because it is 100. We have the potential to have a 100% circular solution, but we did not want to go in front of investors and talk about how good the economics were with carbon credits included. So we have carbon credits zeroed out in all our economics. Everything you see from us has carbon credits zeroed out because that's an upside. To do a carbon credit protocol is what we intend to do, but we have it zeroed out in the revenue stream because this is not a carbon credit business model. This is a manufacturing business model where you get paid for your feedstock. You have valuable products that come out the back end that can go into a market which is completely untapped, has manufacturers under huge ESG pressure, and we literally have the lowest carbon product in North America to deliver to them. Okay, so I think I chatted about it quickly earlier. Here's the plan: pilot facility in Delta, Calgary scale-up facility running by the constructing by the end of this year, and then construction for Toronto and the Pacific Northwest planned for the end of next year. Plan is to get Calgary up and running, 1 quarter of kind of detailed design review, and then into construction for Toronto and Pacific Northwest, and hoping that that's going to be towards the end of 2024. So 3 plants up and running by mid-25 is where I would describe phase 1. So the Calgary facility, We have a 100%. So the Calgary facility is going to be around about our facilities approximately 40,000 tons per year. So each facility will be the same. So as we roll out into an area, and that's probably for a size of a city of kind of 1 to 1.5 million people. So when we go to Toronto, we could literally build 4 facilities in Toronto because that's the amount of shingles that are coming off roofs every year in Toronto. But so the plan is never to scale up or scale down depending on the size of the city. The plan is always to build exactly the same facility. So our engineering company has been employed for 2 things. Number 1, building the first one. But number 2, process improvement as we go. I want plant 5 to be better than plant 4. I want the design for plant 15 to be better than plant 14. Because each one of these is essentially like, the kind of the asphalt shingle or recycling IKEA plant that you get exactly the same plant no matter where you go, with the exception of kind of any change for the weather characteristics in the location, and that's how we are able to roll it out. So Calgary facility targeting 150 to 200 tons a day. We've done the front end engineering design. We've run the Delta facility in Vancouver all the way through last year, and that pilot plant produced asphalt, produced sand, produced fiber that has gone to all the manufacturers. We did a press release a few weeks ago that said all the shingle manufacturers that we went to with asphalt have all come back and said, this works for our process. Please, can we do some manufacturing testing this year? And then essentially we're good to take your product. I mean, these are multi-billion-dollar companies who have taken our product and run it through their R&D, and their R&D has come back and said, we're good to go. Now, were we surprised at that? No. I mean, the asphalt that we gave them was the asphalt from the shingles that they manufactured. So our view was, of course, that would happen. But in multi-billion-dollar companies, you have processes that you have to work through very, very clearly to get sign-off. The Calgary is a really good example of that, where we have a 100% offtake agreement for the Calgary facility for 5 years with McAsphalt. McAsphalt are the Canadian division of Colas, which are one of the biggest asphalt buyers in the world, a €4 billion French-based asphalt company. So to get an offtake agreement with a $4 billion or €4 billion French global asphalt company, you need to go through a lot of process and a lot of due diligence and a lot of technical sign-off. And that's what we did. And so we have a 100% offtake agreement with them. We have resale rights in that agreement, as do McAsphalt, to resell to other shingle manufacturers. So, for example, if we've done a deal with a plant in Washington, then we can actually provide them with early volumes as soon as Calgary gets up and running. Price management has been excellent. So everybody's like, well, what does the price look like? Price is commodity based. It's based on hydrocarbon indexes with a locational differentiator and a sustainability premium. So we've managed to negotiate with a multi-billion-dollar French international company a sustainability premium for the asphalt. And we also have risk management based into the pricing mechanism as well, where we have a price floor above our cash flow break even, which of course from a bank and a debt perspective, et cetera, is a great thing to have. As we look at, here's my assertion on the kind of the low carbon footprint of the asphalt. So if you take a ton of shingles, a ton of asphalt shingles, you put them into landfill and you replace the oil content with manufactured oil content, the carbon footprint of that per ton is about, we've got 195 kilograms of CO2 equivalent per ton. Our facility in Calgary is 77. So we have a 60% reduction on the asphalt that comes out the back end of our facility versus the base case. And we've agreed with McAsphalt to work with the Colas low carbon team across the globe to work on how our low carbon asphalt fits into their process, and then what the benefits that is generated with that step is, and we've agreed to share the carbon credit revenue that comes from that. So carbon credits will definitely come into our revenue mix probably in the next couple of years, but all of that will be done with the customers. So we, in my discussion, kind of around the supply agreements and around the, our view of this being a circular economy, we applied for the government, so we of Alberta, and we got $7.1 million worth of grants. So of course, great non-dilutive funding, and we actually applied for 7.1 million and got 7.1 million, and this was all around the circular economy challenge. So the government put out a call for companies that were doing stuff around the circular economy, and you can see that's our clear view, is the circularity of this and how this actually works. As we look at the economics, so just to be clear, these are economics from 2Q last year. And these are the economics prior to us doing all the testing at Delta, and the Delta testing enabled us to work with the manufacturers that are putting in the equipment for Calgary, and to work with our operations team on how we actually going to run this facility. And the last thing was the customers as well, around the specification of the products that was coming out, and any modifications or changes we had to make to the product mix as it was coming out the back end, with respect to hitting our specifications, all of which has now been landed and is going into detailed design in Calgary. So I would say that the original economics of $12 million, I suspect the capital, our view, internal estimate on the capital is that's more likely to be 15. But the EBITDA has also increased, and we think with the revised operating parameters, etc., the EBITDA should be between $5 and $5.5 million per year. So that's our high level view on where we are. Again, internal estimates going on, not ready for kind of full public release as well until we get those finalized. And here we are on the delivery timeline, right? So we have the Calgary off taking place. Oh, for the US, we have done a major LOI for a major US potential buyer. We've secured non-dilutive funding for the government for the construction of Calgary. We have the 100% offtake agreement. The lease is now signed for the site in Calgary, and that's now being executed. And we're just about to move into detailed engineering for the Calgary design. I'm not going to run through the comparables really. It'll be in the slide deck, but ultimately we're in the waste to energy waste to value sector, where people are taking kind of waste and providing products out the back end. As I said, our patent for the process and our patent work for the process demonstrated that there's nobody else doing this, and so we believe we've got a very clear run at a huge market. And then currently, 17-cent share price in Canadian. We're on the TSXV. ROOOF is the ticker. Market cap of nearly $18 million, and 108 million common shares outstanding, and then warrants of 36 million. And I think and Kin are our communications and our investor relations support. And I think as we tick through the investor highlights, that's the story from Northstar. Hand it back to you, Peter.
All right. Well, Aidan, thank you for that great overview of your company. Why don't we jump into a couple of questions? I have been wondering about a few things. You did say that the potential for credits from the carbon side, carbon emissions, was not something that was a priority right now, but certainly something that may in the future focus into or become a potential stream for you. Do I have that right?
Yep.
Okay, so what I'm wondering is, do you see the possibility of perhaps once, let's say, you're on a more sort of operational status, to, or perhaps even as you lead up to that, to sell what you see as a potential stream of carbon credits to someone else that would buy them, like some kind of a royalty company for revenues, and that would allow for you to tap into the funding that would provide.
Yeah, so I think that's a very interesting question. I mean, I think when we set out, we could see that obviously with the lower carbon footprint, that we believe fundamentally we will generate credits. So that's the first thing. You know, you've got to have a good view of what that looks like. And as you know, until you start manufacturing, you can't generate the credits. And so we've got a, you know, our current number is the engineering estimate for what that looks like. But actually, from our perspective, there is so much appetite for the low carbon footprint with our customers that actually the people that are by far the most sophisticated and the best place to monetize those credits are our customers. So take an example of McAsphalt. Colas have a global carbon group that is literally, when their new CEO came in, he said, I want to reduce the carbon footprint of our operations by 20%. And so all the asphalt guys were like, ooh, that's a bit of a stretch. And so, and so they're looking for solutions to reduce the carbon footprint. And so they literally have a global task force that is doing this. So when I say I would like to develop a protocol for my process in Calgary, what McAsphalt have said to us, and it's in the McAsphalt contract, is that we will work together to work out exactly how that integrates into their process. Because I believe when they do the analysis, their carbon use and the effectiveness of our asphalt with them will actually generate more carbon credits than us if we stood alone. And the contract has with them to share that 50-50. So they will literally buy them and give us the market value for them. The shingle manufacturers are exactly the same. In all our discussions with the shingle manufacturers, they have said, oh, and by the way, when we do the carbon analysis, we are assuming that in our contract, we'll be able to split that benefit. So
I see.
Rather than us trying to work out what our protocol is, actually the benefits that the customers can have, we think will be significantly more, and as a monetization route, way more effective for us.
So they would be, I'm assuming they're in many cases, these are larger companies that are already obviously looking at this aspect of their business in a lot of detail, and have the ability to look at your processing and determine the value of the carbon credits that you're generating and that they would benefit from by buying your product, and how they can factor that in and what they're willing to pay for that. So you're saying that this would potentially have more value to you as cleantech, rather than trying to sell that stream off to someone else and let them monetize.
So a shingle manufacturer, for example, you could take our asphalt and just put it in the front end of a shingle facility, but the shingle manufacturers are analyzing our asphalt. And what happens at the front end of a shingle facility is they basically take asphalt from a refinery, add air and heat it. But our asphalt already has those characteristics. So the shingle manufacturer is saying, well, what happens if we brought it halfway through our process rather than at the front end? And that saving is huge because they don't have, they have no heating, they have no, none of that front end process cost or CO2 emissions or heat needs to be done to our asphalt, which means that the benefit could be significantly in advance of me just selling it as an asphalt at the back of my plant.
I see. Aidan, we've got 3 questions pending, so why don't we try and jump to them? We're a little bit tight on time, but let's see if we can manage that. So the first one is, can you expand on some of the IP protections that Northstar has?
Yep. So there's 3 steps to our process. So the first is the gravel separation or the sand separation. Second is the fiber separation. Last one is the asphalt separation. We have a US patent in place for step number one. The follow-on patent, and we did a US Tier 1 fast-track patent, and it was granted within 8 months. So that means that the prior art that our lawyers saw and the patent office lawyers saw is phenomenal, i.e. there isn't any. First stage patented, second stage and third stage follow-on patents. We've been granted fast track for a Canadian green technology patent, and we have also filed an international PCT patent across for all jurisdictions.
Okay, thank you. Next question is, how will you finance the remaining amount needed for the Calgary plant build-out?
Yeah, so 3 legs of the stool for Calgary. So number one is already secured with the government. The second, we expect in the near term here to enter an LOI for debt for the facility. And then we're working very hard on the third leg of the stool, which we believe can be non-dilutive project equity. We're not 100% there yet, and then we may in June decide that there's an appropriate time to do a market raise to either support that equity, to support the project equity. All, so the government leg secure. We believe that the debt leg will be secure, pretty soon here, and then the kind of the project equity or the equity raise is the thing that we're working on for June, all to be in place by the end of June to start detailed design in Calgary in July.
Okay, so we've got 1 minute. Maybe we can just have a stab at this. Can you discuss how the company has managed costs through a challenging capital markets environment?
So we looked at doing a 3-plant raise in the middle of last year, and then focused that down onto one. We've just been very, very, very careful with costs. We've had significant cost reductions across all consultants. We deferred salaries for executives. Absolutely 100% to manage cash flow. We are very, very clear that investors want real leadership in G&A. And I think that puts the company in a fantastic state when Calgary gets funded, because Calgary funding does not mean that the G&A focus changes. We have to be incredibly focused on the G&A of this company, both in terms of return, but also in terms of investor support.
Excellent. Well, Aidan, I really appreciate this overview of clean tech. Very interesting to hear about such an innovative technology, and certainly something that is necessary if we are to do things sustainably and keep the environment as clean as we can. Thanks again so much for that, Aidan. Great presentation.
Excellent. Nice to meet you. Thanks for the time, Peter, and thanks for the support from Kin.